Welcome to this special show on the minutes of the Monetary Policy Committee meeting. The minutes are out and they indicate, broad brush, that while the Reserve Bank of India members, especially Dr. Michael Patra, seems more worried about inflation expectations rising and maybe getting unhinged, the external members of the MPC, Dr. Ashima Goyal, Jayanth, Varma and Shashanka Bhide, appear to be more worried about growth and the possible overreaction by way of rate hikes. As we know that the members were agreed on a 50 basis rate hike, except Dr. Goyal, who would have preferred a 35 basis rate hike. Otherwise, there was broad agreement in terms of the action and the kind of guidance or the lack of it that the stance indicated. The stance indicated that we are going to continue with the removal of accommodation stance. I'm now joined by the external members, Dr. Shashanka Bhide, Dr. Ashima Goyal and Dr. Jayanth Varma. Thank you very much, gentlemen and Ashima, for joining us. Let me start with the lady. Ashima, this worries about growth. Actually, if you looked at the high-speed indicators, lead indicators, car sales, SUV sales, as well as credit growth, some of the banks are reporting 20% and more credit growth, those that have given us advance estimates. Why would you worry so much about growth? That's what your minutes seem to indicate.
I'm saying that there are uncertainties, primarily due to the global recession threats and the problems in China, etc. And if you look at high-frequency car sales, but they are just getting over a chip shortage and taking advantage of pent-up demand. But even credit growth, though it's very high compared to last year's base, but month on month, the momentum seems to be softening slightly.
Okay.
And then also because monetary policy acts with a lag, and so the rate hikes will take effect, and if we are going into a slowdown, we want to modulate demand so that it compensates for expected slowdown in export demand, right?
Yes.
So we don't want to overdo the demand tightening. And as it is currently, given our forecasted inflation rate, the real rates are positive. So that is adequate at this time.
More of that in the input side, not so much on the consumer demand side, I think. So I guess there are these concerns that the growth that we see is not necessarily all that broad-based. I think so. Particularly, I would also like to mention the investment side. I don't think we are seeing the momentum in investment that is necessary to sustain growth.
Mm-hmm. If you looked at the inflation over the last 3 years, it's only about on 4 or 5 months that inflation has been below 6%. Now, that mandate is cast in stone for you. Dr. Varma, is not that a bother? I mean, what is the sanctity of that 5% forecast? What if it is not 5% but north of it? Is not that a worry? That in the past, the forecasts have not come true. For an overwhelming number of months in the last 3 years, the inflation has not remained under 6%.
That is true. That is true. And out of that 3-year period, the entire period of the 2000, much of 2020 and early 2021, it was a very conscious decision to prioritize growth over inflation.
Yes.
There's no question about that.
Yes.
That was very clear. It was very clear in the resolutions. It was clear in the statement. So that was a very conscious decision that you had a once-in-a-century pandemic that needed a very, very strong response. Now, it was only from around mid-2021 that attention could shift to inflation. And at that time, I argued that the time had come to start focusing on inflation. And the problems, the problem of 6%, 7% inflation today is really the consequence of what we did or did not do a year ago. So slamming the brakes now, saying that inflation is very high is pointless. If we want inflation to come down tomorrow, well, we should have raised rates a year ago, 6 months ago. Now, saying today that, okay, we did not raise rates a year ago, therefore let us raise rates by twice the quantum now, that doesn't make sense. That doesn't make sense at all. Because the raising of rates that we have done over the last 3-4 months, that effect has yet to cascade through to the real economy.
Okay.
So that is really the point, that the only way we could have brought inflation down now was by acting a year ago.
So, now that note has to be written to Parliament, and I guess a meeting will be called of all the MPC members. Would it not irk you that, you have to convince Parliament why it happened? And, the argument that you are still not willing to raise rates, will it wash? Is that a point that bothers you, that you have to defend? And therefore, giving a softer, saying that I will not go beyond 6 right now, will it sit well for Parliament?
Well, I think, I don't know whether it goes to Parliament or government or whoever.
Okay.
But whoever receives this statement, is also aware of the ground reality that we went through in 2000.
Yes, of course.
Right? They are also well aware of the situation in Ukraine. Right? So it is not as if those who are writing the letter are on one planet and those who are receiving the letter are on another planet. They are all living through
Yes.
the same situation that is there. That there are a lot of things that were unexpected that have happened. Yes, and we need to react to that.
Yeah.
But the point is that we also have to ask whether the response already there is adequate or not.
Okay.
We need to ask whether monetary policy needs time, and whether there is any sense in you see the idea that if you raise rates by another 1%, inflation will come down a few months faster. That is a very suspect assumption.
No.
Because monetary policy acts with lags.
Yeah.
Whether it raise to 6 or to 7, it will still take time to
It will.
So there is no escaping the facts that we will have to live with this for another quarter or two before the rate starts coming down.
So, Dr. Bhide, your thoughts? Don't you think more work needs to be done? 4 is not even 1 year down the line.
Yes, but I guess the point I think is what Professor Varma said. So when would we, should we have started this, right? I mean, so I think that is where I think there is a bit of a difference in views.
Okay.
And I think that we are just recovering to get to the output levels of pre-pandemic times. I think so. So I guess probably at the beginning of 2022 was a time when we could have thought of using monetary policy to restrain the inflation pressures at that time.
That is fair.
So I think the target still is 4%, but obviously I think the time that is required to get to 4% is not going to be 1 quarter or so.
I'll come to Dr. Varma in a minute. Ashima, don't you think more work needs to be done to get to 4%? Is that on the anvil? And if it is 2 years away, you're not uncomfortable?
If you see the bands around inflation, they're much wider than around growth. Yeah, so there's a lot of uncertainty for the projection RBI has given. And we must remember that a lot of the inflation in the last 2-3 years was due to these global pressures, supply chain snarls, etc. Now we are facing the possibility of a slowdown, global slowdown, of concerted central bank action against inflation, of oil prices and other commodity prices softening, supply chain bottlenecks coming unsnarled. So we need to watch. We might see that inflation comes to 4 much earlier than the RBI forecast.
Okay.
And in the current situation where demand could slow because of the external slowdown, and we are not in a situation of excess demand, even the current account deficit, a large part of the deficit is due to the high oil prices. And it is Just the recent data on WPI shows that it's coming down. International prices softening reflects first in the WPI. So we will see the CPI also softening. Much of the rise of the last month has come from the fuel and light component, transport and communication, all of which is affected by oil prices, and that will pass through. So we have to watch this space, and that is why I'm saying I'm not ruling out further hikes, but I'm saying that it has to be conditional on the realizations of inflation and growth. And the refinements in our projection as we get more data.
I want to take a break, but thereafter, some very strong worries over the non-transitory nature of inflation have come from Michael Patra. I'll read that out to you after the break, and I want to discuss that. Back in a minute. Welcome back to a discussion of the Monetary Policy Committee minutes that have just been revealed or announced on the Reserve Bank website. I'm speaking to the external members of the MPC, Dr. Shashanka, Bhide, Ashima Goyal and Jayanth Varma. Gentlemen, Ashima, thank you very much for waiting on. Before I come to what I thought were very hawkish comments from Dr. Patra, Dr. Varma, I just wanted this one point from you. Because you are arguing that we have to go to 6 and pause, and we are almost at 590 now, do you not think that that will delay the reach to 4%? After all, your mandate is 4%.
See, the MPC has a dual mandate.
Yes.
Inflation and growth.
Yes.
And it has nothing else. Okay? No current account.
Yes, yes.
So now, when we talk about inflation having been a problem for 3 years, let us remember that growth has been a problem for even longer.
Okay.
We have had unacceptably low levels of growth for longer than we have had unacceptably high inflation. Yes. And we should not take the eye off the ball on growth either. So the question is that you have unsatisfactory inflation, growth, and unacceptably high inflation. Where do you draw the balance between the two, and where do you steer the economy within this conflicting pulls and pressures? And what 6% does is to raise the real rate to around 1%, which would take it to most probably above the neutral rate. So at this point, we are focusing more on bringing inflation down than on supporting growth. A real rate of 1% is more anti-inflation than it is pro-growth. So a longer festering growth problem is being deprioritized in favor of inflation. That is what the MPC is doing at 6%. And to go more than that, to go rate significantly more than that, unless we see that our action so far has been inadequate and we have no evidence of that. To go beyond that would be to jettison the second prong of our mandate. It would be to say we don't care for growth at all.
Okay.
See, bringing inflation down to 4% is important. Restoring growth is also important.
Fair enough.
So the balance depends on which side is the problem worse.
Okay. Okay. Fair point, sir. Actually, Dr. Bhide's arguments also are very much echoing this, as is Ashima's. Ashima, I now want to read out to you what sound like extremely worried statements about inflation from Dr. Patra. He says that, of course, there are those transient elements in terms of geopolitics and energy prices. And now I'm quoting him. What is disquieting, however, is that inflation, stripped of these transitory effects, has become unyielding and tightly range-bound around the upper tolerance band of the inflation target. The Reserve Bank's forward-looking survey suggests that selling prices in manufacturing and services may rise further as pass-through from input cost pressures remain incomplete. Exchange rate volatility is amplifying these core price pressures, especially in view of key import prices being invoiced in US dollar, which obviously has appreciated. And further, I think this is very important. Inflation expectations are rising with signs that they are becoming unanchored over a 1 year ahead horizon. Dr. Bhide is also pointing to this 1 year ahead inflation becoming higher compared to the previous survey. And now again, I'm quoting Dr. Patra. taken together with the closing of the output gap, rising capacity utilization in manufacturing, surging demand for services, and the pickup in spending as the festival season nears, monetary policy must move to red alert, as hawkish as it gets. Ashima Goyal, you want to comment on this? He's really worried about inflation.
I think much of Michael Patra's commentary is about US and US inflation.
No, this one is on India, ma'am. This one is on India.
India, a major factor. He is saying firms will raise prices, but they have not. We've had even consumer non-durables actually cutting prices, like palm oil, soaps, and so on. Firms are not, because they're realizing that demand is slowing. They can't pass on prices, and they have restructured and reduced costs. And the most important factor that I see causes second-round effects that happened in the early 2010s and 11 was high wage growth. We don't see that at all. Right? So the second-round effects are not there. We are just at an inflection point where those supply-side pressures are easing, the global supply-side shocks. Finally, earlier Michael Patra was very dovish. He was one of those who felt that it's temporary supply side.
Yes, that's why I read out, because it clearly seemed.
He's switched to the other. I think moderation and being watchful is much more helpful. They really realize that.
No, I take it seriously that he seems to have changed his tone, and that's why I, kept that quote in front of you. Well, actually, I don't have enough time to get the same comments from others, because I want to spend the last few minutes on your thoughts on financial stability. I know it is not an MPC mandate right now, but I separately want to ask all three of you this question. Dr. Bhide, you go first, sir. Financial instability. I mean, look at the way pension funds have been running helter-skelter in the UK. Would you worry that this can be contagious? Separate from your mandate, sir.
No, obviously, financial stability is core of policy. And I guess not just monetary policy, I think, but the financial stability is important, I think. So I don't know, from the perspective of the MPC, I'm sure that one constituent of the strategies that are required for macroeconomic stability is low rates of inflation. So in that sense, I think, we should worry about financial stability. And I think the inflation targeting and targeting at a relatively low rate, I mean, that is important. So that's all.
I buy that point. You all have argued it admirably. I'm not taking away. I'm just worrying whether the manner in which there is, today Janet Yellen complained of illiquidity in the US Treasury market. I mean, you wouldn't have, expected that kind of a statement from a market which we thought is large and liquid. Dr. Varma, just your thoughts, again, not as an MPC member, but as a seasoned watcher of financial markets. Is this something that can become contagious and become destabilizing?
See, financial instability is usually a product of excessively low rates sustained for excessively long. I do not think that the low rates in India lasted long enough for that problem to come in. In some other countries of the world, it has lasted too long. In India, I think we had excessively low rates for about 6 months to a year, from mid-21 to early 22.
Yes.
That is not really long enough to build up excessively large bubbles. We probably had a mild bit of asset price inflation, but not really enough to blow very large bubbles that could become stability threatening. That is my view, that it wasn't long enough for that to happen. Yes, some of it came from the bubble being blown by global central banks, but that was also not long enough and severe enough to create a financial instability issue. It is enough to create a lot of pain for a lot of people, which is fine. People should know that these markets are volatile, that they can go up and they can go down. So they will suffer pain, but not enough pain, in my view, to destabilize the financial system.
No, actually, even the governor points out that our balance sheets are extremely healthy at this point in time. No, I'm not worried about financial instability of any bank or corporate in India or any excessive FX exposures, but more generally instability in global debt markets. Do you see them having spillover effects on India? That's my question. Ashima, your final thoughts.
I think we are at a very good point in India because we went through 10 years of really tightening and cleaning up the financial sector.
Yes.
And we have very low leverage. And I think we've learned the lesson that too tight liquidity and too high interest rates, as well as too low, both create instability. So we are moving towards sort of a moderate policy where liquidity will be in surplus, but not too much. And rates will be moderate, not higher than 1% real rates. So I think all that makes for, and we have reserves, etc. So all that makes for, we have fiscal monetary coordination, good targeted fiscal support for those who need it without too much of a rise in fiscal deficit. So all that gives us the space for policy to smooth external shocks.
Yes.
And this is very, very important.
Yes. Yes, you make that very clear in your minutes. Thank you very much, Dr. Varma, Ashima and Dr. Bhide. We have to wrap up because we're out of time. We wrap up on this edition of the RBI MPC Minutes and their analysis. Thank you very much for watching this special show.